Welcome to this deep dive into PennyMac Mortgage Investment Trust, ticker PMT. We're looking at their first quarter 2025 earnings call. Think of this as your fast track to understanding the key takeaway. So let's jump right in. What were the actual results they posted?
Yeah, okay. So for Q1, PMT reported a net loss to common shareholders. It was small, around $1 million,
Okay.
which shook out to a diluted loss of 1 cent per share for you.
Right, a loss. But why? What was behind that?
Well, it's key to understand it wasn't necessarily, a core business issue. It was more these big market swings. We saw a lot of interest rate volatility and credit spreads widened out quite a bit.
Market headwinds then.
Exactly. And those factors basically offset what they said was a otherwise pretty strong underlying income.
Interesting.
But importantly, even with that loss on the books, they declared a common dividend, 40 cents per share for the quarter.
So they're still returning cash despite the paper loss. What about book value?
That dipped slightly, came in at $15.43 per share at the end of March. So yeah, a bit of a mixed bag, really driven by those market forces.
Okay, got it. A loss driven by the market, but the dividend holds.
Yeah.
Let's dig into how management sees the bigger picture, the market environment, right?
Right. They spent some time on that. They really emphasized just how, choppy the interest rate environment is. Extremely volatile was the term used.
Oh, kidding.
And looking at the whole year, 2025, they're projecting maybe a $2 trillion market for industry originations overall.
$2 trillion. How does that break down?
They see it coming from both refi and purchase activity, but, moderate contributions from each. Nothing explosive.
Okay. So given that kind of environment, what's their strategy? How are they playing it?
They're really highlighting their diversified portfolio, sort of spreading the risk,
Makes sense.
They're not putting all their eggs in one basket. Plus, they stress their focus on keeping costs efficient and maintaining strong risk management.
Risk management is huge in this climate.
Yeah.
Did they mention specifics on how they're handling that for you?
They did. They pointed to their interest rate hedging program, which is designed to, cushion the blow from unexpected rate swings.
Okay, hedging. What else?
And also their financing structure for most of their credit risk transfer, their CRT investments, it's largely non-mark-to-market.
Non-mark-to-market. What's the key takeaway there for us?
It basically means the value isn't immediately slammed by short-term market jitters or spread widening. It gives them more breathing room, more stability compared to assets financed with mark-to-market debt.
Right. Less forced selling pressure, maybe.
Exactly.
Now, you can't talk about PMT without mentioning their relationship with PFSI, PennyMac Financial Services.
Yeah.
How does that fit in? What's the advantage?
Oh, it's huge for them. The call really emphasized the synergies. First, PMT gets access to PFSI's whole operating machine management servicing origination platform.
So a built-in deal flow.
Pretty much. And second, it lets PMT deploy capital into mortgage assets, these long-term assets, without getting bogged down in the day-to-day operational stuff of actually making and servicing the loans.
That sounds efficient.
It is. They get the investment side without the operational burden. And thirdly, because PFSI originates so many loans, PMT can package them into private label securities. This positions them well if, say, the GSEs, Fannie and Freddie, reduce their footprint someday. PMT could potentially step into that gap. It's a real strategic plus.
Okay, so that private label securitization, they're essentially creating their own investments. Tell us more about that activity.
Yeah, this is a core part of their strategy now. In Q1, they actually completed 3 deal securitizations of investor loans.
3 in 1 quarter.
Yep, totaling about $1 billion in unpaid principal balance. And from those, PMT held on to $94 million in new investments. And they're expecting pretty good returns on those mid-teens return on equity is what they mentioned.
Mid-teens. What gives them an edge there?
Well, because PFSI produced the loans, PMT has intimate knowledge, better due diligence. Plus, since they often keep the servicing, they have more control if a borrower gets into trouble. Better loss mitigation potential.
Makes sense. What's the plan going forward for these?
They're aiming for a pretty steady rhythm, about 1 non-owner occupied loan securitization per month, and then 1 jumbo loan deal per quarter, starting now in Q2.
So a consistent pipeline they control, something for you to watch.
Definitely.
Let's shift to the existing portfolio. You mentioned a lot of it is older, seasoned stuff.
That's right. About 2/3 of their shareholders' equity is in mortgage servicing rights, MSRs, and GSE lender risk share deals from roughly 2015 to 2020.
And how are those expected to perform?
The outlook is pretty positive. 2 main reasons relevant for you. First, those loans originated when rates were super low.
Right, so less prepayment risk now.
Exactly. People aren't rushing to refi 3% mortgages. So PMT expects to keep collecting servicing fees longer. Second, delinquencies are still pretty low overall, consumer credit's holding up, and homeowners generally have a lot more equity than they used to. That helps.
On the MSR specifically, they're a big chunk.
Yeah, about half the equity. They actually get a bit of a tailwind from higher rates because PMT earns more income, placement fee income, on the cash balances they hold for borrowers' taxes and insurance.
Okay, so the seasoned book sounds like a stabilizing force. How did these different strategies actually impact the Q1 financials then? Can you break that down?
Sure. So the credit-sensitive stuff, the CRTs, the non-agency bonds, that bucket, contributed about $1 million to pre-tax income overall.
Net positive, okay.
Yeah, but it was a mix. They had a $5 million loss from the newly created CRT investments we just talked about.
Offsetting gains elsewhere.
Right. Offset by a $4 million gain in non-agency subordinate MBS and another $2 million gain from CAS and Stacker bonds.
Got it. What about the interest rate sensitive side?
Yeah.
MSRs and such.
That side saw a pre-tax loss of $5 million. The big driver there was a $56 million drop in the fair value of their MSRs.
Why the drop?
Because mortgage rates actually dipped a bit in Q1, which increases the modeled expectation of future prepayments. Lower expected life for the servicing asset.
Okay, so rate moves cutting both ways.
Exactly. That MSR loss was partly offset by a $65 million gain in the value of their MBS holdings because lower rates generally boost bond prices. Then you also had a $40 million loss on their interest rate hedges, which are meant to offset some of this, and a $16 million tax benefit related to MSRs in their taxable REIT subsidiary. So lots of moving parts based on rates.
Definitely complex. Let's touch on correspondent lending, another piece of their business.
Yeah.
How did that perform in Q1 for you?
Overall volume they acquired through correspondent partners was $23 billion. That was actually down from Q4.
Reflecting the broader market slowdown.
Yeah, pretty much mirrors the overall dip in originations. Of that $23 billion, PMT itself acquired $3 billion. They kept about 21% of the conventional production they could have.
And the income from that.
It generated $10 million in income, also down from the prior quarter.
Anything changing there going forward?
Well, they have a renewed service agreement with PFSI starting in July. Under that, PFSI will initially buy the correspondent loans, but PMT keeps the right to buy up to 100% of the non-government loans from PFSI. So flexibility is key there.
Okay. Let's talk future potential. They mentioned a run rate.
Yeah.
What's the current outlook there for investors?
Right, the run rate. They estimate it's currently averaging about 35 cents per share quarterly. That's down just a touch from 37 cents previously.
Why the dip?
It's mainly the interplay of strategies. They said the return potential on credit-sensitive strategies has actually increased because credit spreads widened out, higher potential reward for the risk. But the potential from the interest rate-sensitive side has decreased a bit. That's due to compression between longer-term asset yields and the short-term rates they borrow at to finance them.
The yield curve flattening, basically.
Exactly. And they did say if the yield curve steepens, meaning longer rates rise more than shorter rates, that could boost the overall run rate. So the curve shape is definitely something for you to watch.
Makes sense.
Yeah.
Did they make any big capital moves in the quarter? Debt issuance, anything like that?
Yes, a couple things. In February, they issued $173 million in new unsecured senior notes due out in 2030. They also used some cash to retire $45 million of older CRT term notes.
Cleaning up the balance sheet a bit.
Seems like it. And they signaled they'll likely look for more chances to raise debt capital through the rest of 2025, partly thinking ahead to an exchangeable note maturity coming up in 2026, and also to fund potential growth in that securitization business we talked about.
Okay, proactive capital management. Let's get to the Q&A. Analysts always ask tough questions. Any key insights from that part of the call for you?
Oh, yeah, definitely some useful nuggets in there. First, they acknowledge book value has probably slipped another 2-3% since the end of March.
Okay, so continued pressure.
Yeah, again, driven by rate volatility and wider spreads. But, and this is important, they stress their hedging has provided, quote, significant insulation. They also reiterated that their liability structure, especially that non-mark-to-market debt on the CRT side, gives them resilience in choppy markets.
What about capital allocation? Where are they focusing new money?
Good question. They said right now the focus is more on adding to the credit-sensitive strategies rather than bulking up significantly on the interest rate-sensitive side like MSRs. They also don't expect a big jump in the percentage of loans they retain from PFSI in the back half of the year.
So sticking to the plan mostly.
Seems like it. They sounded generally happy with the current allocation, emphasized growing the credit side, being a regular issuer in securitization, that's key for them. They want to keep doing about one jumbo deal a quarter and still plenish the interest rate sensitive side to some extent, but the growth focus is credit.
Any updates on lending activity more recently?
They mentioned seeing a pickup in correspondent fundings late April and into May as loans locked earlier finally closed. But they're sticking to that $2 trillion overall market forecast for the year, with the big caveat that it's all very rate dependent.
Of course. What about the dividend, given the run rate dip?
They expect it to remain stable. Their reasoning was that the run rate softness is mostly tied to the yield curve compressing the interest rate sensitive strategy returns. And their view is that the yield curve should, normalize eventually.
Okay, stable dividend expectation. Anything else jump out from the Q&A?
Yeah, one more thing on returns. Because credit spreads widened, they said their target returns on the subordinate bonds, the riskier pieces in their new securitizations have actually increased to the mid-teens, maybe around 15%.
Higher risk, higher potential return.
Exactly. And they really played up the advantage of being able to create these securities themselves in the current market. They see that as a big edge. Oh, and they clarified that while some less risky parts of their securitizations might act a bit like agency MBS from a rate sensitivity perspective, the main investment focus from these deals is definitely the credit-sensitive subordinate bonds, much more like CRT.
Got it. Lots of detail there. So wrapping up the analysis part, what's the big picture for someone trying to understand PMT right now?
I think you see a company navigating a really challenging mortgage market. Interest rate swings, credit spread moves, those are definite headwinds. However, their strategy seems geared for this, focusing on credit-sensitive investments, leveraging that unique relationship with PFSI, those are potential advantages.
And the underlying fundamentals.
The existing portfolio benefits from still strong consumer credit and homeowner equity, which provides a buffer. And looking forward, the growth of their own securitization platform, that consistent issuance cadence, that could really be a key performance driver for you to monitor.
Plus the stable dividend outlook.
Right. That might appeal if you're focused on income, despite the market noise. It's a complex situation, but those are the core elements, I think.
Okay, great summary. Now time for our favorite segment. This is not financial advice. Let's cook up an outrageous, but maybe, just maybe, plausible trade idea based on all this.
Okay, let's get weird. Okay, so PMT is leaning into these non-owner occupied loan securitizations, right? Higher return targets there. Let's assume that continues. Maybe it's volatile, but ongoing. Here's the crazy trade. Go long PMT and simultaneously short, let's say, a major home improvement retailer stock, like a Home Depot or Lowe's.
Okay. Where's the connection there? That feels pretty random.
It is, but the stretched logic is this. If rates stay high or the economy slows, maybe fewer people buy primary residences or undertake huge renovation projects funded by home equity hitting the home improvement stores. But perhaps the market for investor loans, PMT's focus, holds up differently, maybe driven by rental demand or different capital flows. Or PMT's specific niche execution allows them to outperform.
So it's a bet on the niche investor loan market being less correlated with the broad homeowner spending cycle than people think, and on PMT's ability to navigate it.
Exactly. A super nuanced, probably wrong, bet on segmentation within housing finance versus broader consumer cyclicality tied to homeownership. Totally speculative, purely a thought experiment, definitely not financial advice, just making you think about weird connections.
Definitely gets you thinking. Okay, that is a wrap on our deep dive into PennyMac Mortgage Investment Trust's first quarter call. We've unpacked the results, looked at the strategy, the market context, and even floated a truly bizarre trade idea. Remember, this is all for educational purposes. It's not advice. Please do your own homework before making any investment decisions. What was the most interesting point for you in all this? What connections are you drawing? Something to chew on until next time.